Thanks, Janelle, and thank you, BCI, for having us. I really appreciate it. It's always good to be here. Right. I'm here to talk on fixed income and our views on fixed income and the opportunities in the fixed income market. And I promise I will. But as you've all by now seen in the last couple of months, we've had all this volatility in the markets and all of these sentiment-driven issues that have been driving markets. So I've entitled my presentation, Fear and Greed. And I think I'm going to focus on the fear because I think we've been feeling quite fearful in the last couple of months. As Morgan Housel puts it, he says investing is not just about the money. Investing is about our relationship with greed and fear. And I think one of my colleagues from Coronation this morning was mentioning fear. This whole fear thing came up over and over again. And most certainly it's been proliferated through our markets, not only the fixed income markets, but generally through all the asset classes. But let me focus on the fixed income side of things. You know, I thought, okay, how do I quantify this fear? Because everybody's saying, we're worried, we're fearful about things. And the closest I could get was to an index from CNN. We can look it up on the net, it's quite easy. And they use about 7 factors, input factors such as market momentum, market volatility, and junk bond demand. And they put this into a system. And last month when I submitted these slides, that was sort of around about the 3rd or 4th week of April, we were firmly in extreme fear territory because of these indicators. I must say things changed very, very quickly. When I looked at this index last night, we were in greed territory again. So I've quite a few of the speakers this morning explained how quickly things can turn around and change. But to quantify it, and I was thinking, why are we feeling so fearful? Why are we feeling so fearful? And I was not short of issues to make us feel fearful. We've had the Trump administration, we've had geopolitical uncertainty, policy changes, interest rate changes, and of course the tariff wars, everybody's talking about it this morning. And then bringing it home, we had our own budget bungle. I call it the budget bungle. We're hopefully going to have one now on the 21st of May, and it will be the final one. And of course, we've had a VAT roller coaster, not to mention the government of national unity, which and the shenanigans around that, as was explained earlier this morning to us. So what I did was, and I said to myself, look, fear and risk is very closely related. And I went back to the World Economic Forum Global Risk Perception Survey in 2024. And at the beginning of last year, we were more worried about the weather than really about geopolitical events. And then the beginning of 2025, suddenly this changed and state-based armed conflict became a lot more prevalent on our radar in terms of the risk perceptions. But we were still worried about the weather. Geo-economic confrontation only made about 8% of the survey at the beginning, and that's the beginning of this year. You know, if we break that down in terms of the survey that they did over the next 2 years, geo-economic confrontation, which is what we've been experiencing in the last month or two in extreme sense, only makes number 8 on the list. This wasn't too long ago. This was earlier on this year when the survey was done. We're still worried about the weather, and we're worried about the weather for the next 10 years as well. So let me look. I thought let's just calm down and let's look at the fundamentals, because a lot of the market at the moment is being driven by sentiment, and it's not being driven by the hard data. And in our fixed income market, I think it's very, very important to understand that hard data and the way in which it's driving our fixed income market. I always say that our fixed income market is driven by a myriad of factors. It's not just one factor. There can be a hot button or a hot event that happens at any one particular point in time that will move things for the short term, but ultimately it's the hard data that shines through. So from a global perspective, I'm just going to look at 3 factors, and in the local perspective, I'll look at a few more, and then tie it together. But we've seen global growth moderate, and it's expected to moderate as well, as we heard this morning from a few of the other speakers as well. But of course, the trade barriers that have been put in place, the uncertainty of policy surrounding investment demand is creating a bit of tension in the growth space. But in essence, ultimately, that's keeping a lid on growth. And of course, this word of heightened uncertainty comes up over and over again. And if we experience further trade fragmentation, which could be very real, up until yesterday, we had a lot of tension between China and the US, and that seems to have settled to a degree. But with global growth being as subdued as it is, it could keep a lid on the yields that we do see. The International Monetary Fund also does growth projections. And in 2024, they said global growth in 2025 is going to be about 3.2%. Beginning of this year, they downgraded that to, I think it was 2.8%. So most certainly there is a lot of muted growth expectations, but also there's divergence in those expectations as well, especially between developed economies and also emerging economies. And even within the developed economies and the emerging economies, we're seeing policy gaps, trade measures that are quite uncertain, and weakening sentiment across the border as well. The other economic fundamental I want to have a look at that's driving our fixed income market is obviously inflation, and the projections that we're seeing from headline inflation, and this is taken from the OECD report, interim economic report that was done in March this year. They were saying that inflation paths are a little bit higher than previously expected for a reason, because we are seeing trade costs potentially going up. I mean, I think it was explained this morning, Trump went in very, very hard, but it's still 30% to China, and it's 10% on the other side. So it's not gone away completely, and we only got a 90-day pause in which there will be negotiation. What happens after that, I think, is quite important as well. So potential for inflation, even though it's trending down from high base effects, to be a little bit stickier than anticipated. And so you have these two opposing forces. You have global growth that's maybe keeping yields down, and you have inflation potentially could be sticky, that will potentially push yields a little bit up. The third fundamental that I'd like to talk about very briefly is monetary policy, because I think this is quite important, and it's very closely related to inflationary pressures, but we do see quite a bit of divergence once again between developed markets and emerging markets, where the expectation is for rates to remain stable or to come down. For example, in developed markets, we saw the FOMC hold rates steady with the last meeting, but there's great expectation now that we'll see, especially after yesterday and last week's events, we'll see a 25 basis point cut in September and again in December in the US. But of course, there is disparity between emerging markets and within the developed markets. I think of Japan and countries like Brazil and Mexico, where you have perhaps a lot more other factors at play that could drive rates either way. So monetary policy is quite important, because that's going to dictate how rates are going to be, at least in the short term. From a global perspective, we are seeing monetary policy being applied to a degree that might hold rates down a little bit. Then bringing it home from a local perspective, our growth is fairly subdued as well, even though we have seen a bit of a rebound in agriculture and consumption, household consumption picking up, and we've seen Eskom keeping the lights on, so we have increased production and consumption of electricity. Our economy is still pretty fragile. We know this. We know the fact that we've got high unemployment, we've got high or low business confidence, and consumer confidence is quite low. So theoretically, our growth, global growth, our growth should keep a lid on yields as well. Our inflation, it's coming off of a very high base at this point in time, but it's fairly muted at this point in time as well. And the reason why I mention inflation, because within yields, especially yields like bond yields, expected inflation is embedded in those yields. And we've seen inflation being fairly benign at this point in time. We're losing the high base effects, so that might not always be the case. But of course, inflationary pressures, if it does rear its ugly head abroad, and as a result of the tariff wars that's going, or tariff tension, then we could see a bit of inflationary effect on our side. There's one component of inflation that is quite stubborn locally, and that's food inflation. I've got the little picture up there that shows which prices of food have gone up. I think we just got to watch that component quite closely. But overall, looking at the hard numbers, it's also keeping a lid on yields at this point in time. Our monetary policy, from a local perspective, and our MPC have said at their last meeting that there's upside risk and downside risk to inflation. I'm not just think it's a way of saying we're not quite sure where we are at this point in time. But, and they've lowered their GDP forecast as well. So low and stable inflation, benign inflation, is going to also dictate the path of our monetary policy. So I think it's quite possible or very probable that we will see a rate cut at the next MPC, which happens at the end of the month, as opposed to the Fed, who's taking a more sort of wait and see, let's see if the dust settles. I mean, that we've seen being said by the governors and alike. In terms of our fixed income environment, it's always driven by another factor, our currency, and plenty of events have evolved around our currency over time. We've seen our currency strengthen lately, but we're not immune to the shocks around the world, whether that is the introduction of tariffs, whether it is our GNU having not deciding on certain issues, whether it is our budget bungle, whether it is a VAT hike or not. We see our currency being susceptible to that, and then alongside that, it tends to feed through to the volatility of our yields. A small word on credit spreads, because that all affects our fixed income market. I'm just trying to fit in all the factors that influence our market at this point in time. The credit environment, the yields are still fairly low at this point in time and compressed at this point in time. Supply or demand is outstripping supply at this point in time. I think funds are selling their soul for yield. Everybody's searching for yield, and it's very difficult to find it in the standard place as far as credit is concerned. So I think an environment we've got to just be very careful of, but also need to keep an eye on how that develops going forward, because credit spreads are exactly that. It spreads above a base rate such as JIBAR, for example. I think once we see those credit spreads start to widen, but it will also take an event for that to happen. Yield curve is something that we all look at as good bond fund managers. Is there value in the yield curve? If you ask a bond manager, he's going to tell you, yes, I do think there is opportunity in the bond market. We heard this morning, I'm not going to repeat any presentations, but we heard this morning there's potential for very good returns to come from the bond market, especially if we do see bull steepening as a result of interest rate cuts and the like. So, what does that mean in terms of us at Cadiz? I can speak to you a whole day about all these economic fundamentals and monetary policy and liquidity and valuations, but we have to make it real. So what we do is we pull this into our investment process, and this chart on the screen is really just the output of it, or the consequence of it. Bars above the line indicate that we have a little bit of we have a bullish tendency, and bars below the line indicate that we have a negative tendency. So at this point in time, yes, we were quite bullish last year. The beginning of this year, a lot of those event risk issues started creeping into our process, but we're starting to work through that. We're seeing through that, and we are actually starting to see a little bit of bullishness return to our process and to the way in which we position our portfolios. That you can see in our funds, such as our enhanced income fund. I will not dwell on it. Our absolute yield fund, you can go and have a look at it, and all our thinking is embodied in those funds and portfolios. So all that's left for me to say is thank you, Nzakenza and Tsonga, and because they are celebrating 100 years, Baie Dankie. Thank you.